All right, let's kick this off. Welcome to this webinar on the Brexit, which is basically a colloquialism that has come about in the last few years that describes the potential exit by Britain or the United Kingdom from the European Union. We're going to discuss today a little bit about us, as always, but more importantly, what exactly is the Brexit? What's happening? Why is the United Kingdom considering it? What are the economic impacts, both for the UK and also the wider Europe? What is the impact on FX, especially the FX majors? And what do you do as a trader? All right, whether you are a mean reversion or price action, a day trader, a scalper, this could affect you. So it's probably important to take these data points on board. And at the end, we're going to have a Q&A as always, where you can ask me the questions if I've not been clear about something, or you can email webinars@hotforex.com. The contents of this material are provided by a third party and not Hotforex and are for informational purposes only and do not constitute investment advice. Hotforex and Blue Sky Binary assume no responsibility for any potential errors, inaccuracies, or omissions in this material. Nothing in this communication contains or should be considered as containing investment advice or an investment recommendation or a solicitation for the purpose of purchase or sale of any financial instrument. Any views or opinions presented within this material are solely those of the authors and do not necessarily represent those of Hotforex unless otherwise specifically stated. Currency trading may not be suitable for all investors as it carries a high degree of risk to your capital. Trading such products is risky and you may lose all of your investment. Past performance is not indicative of future results. Poor fill rates, expiry times, market volatility, and platform errors could result in losing trades. Before deciding to invest in currencies, you should carefully consider your investment objectives, level of experience, and risk appetite. You should be aware of all the risks associated with foreign exchange and currency trading and seek advice from an independent financial advisor if necessary. To give you a quick introduction on who we are for those of you that are new here, we're Blue Sky Forex. We're basically part of Blue Sky Binary, an education, research, and trading group. We are a group of senior traders that teach and trade and also research the FX markets. We also provide 24-hour trade support and analysis to allow both binary option and FX traders to trade safer. We are presenting this webinar on behalf of Hotforex in order to educate you and help you become highly profitable currency traders. So what exactly is the Brexit? In short, today 28 nations comprise the European Union, and the UK is seeing increasing support internally, especially this year, to pull out of the EU project, resulting in significant macroeconomic consequences for both the United Kingdom, Britain, and Europe. And also, this will have a resulting impact on their currencies. Now, this is a complex and drawn-out process with many uncertainties that have no certain outcomes at this stage. All right, there are only probabilities that market and research theorists and analysts are putting on various outcomes, but nothing is set in stone. Currently, around 20% to roughly 30% of the UK Conservative Party, which is in power, their MPs are in favor of an exit, okay, 20 to 30%. And around 43% of the nation, based on polls that were recently carried out by Survation, wish to exit. All right. This is, from the national side of things, the highest sentiment has ever been for the UK to exit the bloc. The current Conservative Party that is run by David Cameron will be attempting to renegotiate the terms of its membership to a more favorable one, so that by the 23rd of June this year, and this is a very important date for you to take down, the day the UK public votes to actually stay or leave, public sentiment has hopefully swayed and nothing changes the status quo, which, by the way, has been placed since 1973. All right, that is the year that the UK actually joined the European Union, so it's been over 40 years, and it'll be probably 46 to 47 years before they finally take a vote on when they're going to stay or leave. All right. Now let's answer, why exactly is the UK considering leaving the European Union? And here are the 4 key reasons behind the departure. There are others, of course, but these are kind of the main ones that tend to crop up the most. Immigration is single-handedly the biggest issue in the public sentiment eye. Not necessarily on the government side of things or business side of things, but on the public side, immigration is a very big topic. The ministers wish to stop EU immigrants from receiving benefits until they have been resident for 4 years at least. Okay? They wish to limit the offtake on top of that the UK is required to participate in during refugee crises like we see now, right? So each UK member country has an allotment and they are required to take on some of the refugees, and they want to limit the amount of offtake because the UK already has a lot of immigrants on board. The second point is competitiveness of the actual nation itself. The UK wishes to reduce the burden of excessive regulation, which is what they call it, that the EU members face conducting business in the bloc. All right. Furthermore, they want to access new markets or a single market. They're proponents of the single market concept, and they want to access new markets through what they call turbocharging free trade deals with the USA and Asia, which right now are not entirely competitive, as the UK feels they could be because they are part of the EU. The third point is economic governance. The UK wishes to obtain confirmation that the euro is not the only currency in the EU, which ensures countries outside the eurozone are not disadvantaged. All right? The UK does not want to be forced to contribute to eurozone bailouts on top of that. This has been a big source of controversy for the UK coffers, for the UK budget. They have been contributing to repeated bailouts, and they do not want to be forced. It doesn't mean they don't want to contribute, but they do not wish to be forced. And last but not least is the issue of sovereignty. The UK wishes to give greater powers to national parliaments to block EU legislation as and when required in an attempt for nations to retain their sovereignty and, of course, themselves. Okay, so these are the 4 points: immigration, competitiveness, economic governance, and sovereignty. So let's discuss the economic impacts. Here are the potential economic consequences if the UK were to leave the bloc. Trade would be affected the most. UK's biggest trading partner is the EU. Leaving it could leave the UK businesses in what we call a catch-22 situation. They may not enjoy the favorable treatment they do currently when transacting with other EU businesses, but may have far more greater freedom to pursue their own pricing and other networks outside the EU that they don't currently enjoy. All right. The second point is labor and labor mobility. UK has been a net beneficiary of free labor mobility across the EU. This has attracted an international talent pool or skill set into the economy and helped productivity. Leaving the EU could have the opposite effect. The third point is foreign direct investment, or FDI. According to the London School of Economics, leaving the EU and securing a free trade agreement with the EU thereafter, which is absolutely necessary for the survival of the UK, will result in a loss of around 2.2% of UK's net GDP, right, which is not insignificant. Okay? But here's the scary thing. If they are unable to secure a desirable trade term after they leave with the European Union, the UK could suffer a hit of between 6.3 and close to 10% of their GDP, making it a very, very risky gamble, especially given the ensemble of unknowns, right? The EU itself would actually face a hit, an economic hit, over a 10-year period, as this is how long it would take for the UK to actually leave, right? So from a transactional standpoint, a legal standpoint, even if the UK were to decide that they are leaving the EU in 2017, it would take until 2025 till 2027 for that actually to completely take effect, given how complex and intricately linked UK's trade and business sector is with Europe. So these are the key economic impacts: trade, labor, foreign direct investment, and it's a very material hit to their GDP. So what is the impact on FX and the currencies? So here are the potential impacts on the euro. The euro is considered a risk-on asset. It's not really a haven asset. And in the event, the public referendum, which is held on this June in the UK, does show a strong vote in favor of a departure. This could result in a significant sell-off in the euro, either going into that announcement or certainly after it, if it is in favor of a departure. Net, the EU would stand to lose out if the UK left. All right. And I've not included the GBP here, the British pound, because it's a very obvious move. The British pound would fall dramatically if that was the case. The US dollar is a risk-on asset. Okay, similar to the euro, but even more so at certain times, but also a haven asset or a safety asset in other times. The link between the potential departure of the UK and the dollar still remains unclear. What we are probably going to get is heavy volatility in June owing to this. And another reason why we can't give a clear reading on what will happen to the US dollar if the United Kingdom decides to depart is mainly because the US story this year, the greenback, is purely dominated by a data point driven recovery, which allows Yellen and the Federal Reserve to raise interest rates in line with expectations. If you remember, they raised rates at the end of last year, and they gave quite a bullish roadmap for normalizing interest rate policy, right? And so far, the data has kind of been mixed, and it's leading market participants and research analysts and generally speaking investors to really doubt if the US can raise rates, which is why the non-farm payrolls number is of crucial importance tomorrow, and of course, other US data points. So the point here is that the US dollar, it's unclear. Generally speaking, the euro will be more affected by it. And then you have the Japanese yen, which is the largest haven asset. It is considered the most stable ex-growth economy, so to put it. And the UK leaving EU is bad news at first, and hence the Japanese yen may actually experience strength. It may actually rise as there is a flight of capital towards safety. And along with it, you would also see a rise in the Swiss franc. All right. So the question now is, what does all of this mean for you as a trader? So let's decompose this into 3 time frames. There's the now, so after today's webinar. And then there's then, which is on the 23rd of June of this year when the UK public actually votes, which is the actual referendum. And then you have the thereafter. What happens thereafter, right? These are 3 separate time frames. Now you do nothing. You just assimilate this information, you start doing a bit of research on it, get wise on the topic, because this is going to be a significant event either way. And you do nothing until mid-June, as the market will not start to worry about that until then. So you still have a few months. However, in the week going into this announcement, there's going to be a lot of volatility, right? No real trends are going to be forming. No real investors are going to be committing, whether in the US, on the equity markets, the fixed income markets, or in Europe, to any real new investments, right? In any meaningful way, because they want to understand, they want to get a read on this. So on the 23rd of June or a day before it, you may get heavy volatility surrounding the public referendum. And depending on how it goes, if they do decide to leave with a landslide, and it is important that it's not just a marginal victory for the proponents of a breakup, you may have what is termed as a Six Sigma or a near Six Sigma event, which rarely happens in the markets, but you do get it once every 1 or 2 years. The last one I believe we had was in January or February of 2015, which is when the Swiss National Bank decided to remove the floor, if you will recall, against the euro between the Swiss franc, and that resulted in a 1,500 pip move, which almost bankrupted certain FX brokerages. Certainly some it did bankrupt. And you want to make sure your stops on that day are very, very tight. So you may get a Six Sigma move with drops of 200 to 500 pips on cable, British pound USD, Euro GBP, and slightly less on the other majors for the reasons I mentioned earlier, right? But it is strongly suggested to not trade that week unless you actively wish to trade the news with a strong stop loss management routine. And then, of course, the question is what happens thereafter? So the actual government referendum isn't until 2017. So David Cameron has time to negotiate better terms with the US until then. And so it won't be decided in finality what exactly is going to happen, right? The government has the final say. Obviously, they have to do what the public says to some degree. If the public unanimously votes for exit, the government can't just turn around and say, hey, listen, we're staying. But generally speaking, it will set the tone for the rest of the year after June of this year, and certainly into next year in terms of what's probably going to happen, right? And so if the referendum does vote in favor of an exit, the actual government referendum, which again doesn't happen until 2017, will mean that there will be a lot of uncertainty. And you're probably going to get a lot of strange volatility patterns in the British pound for the rest of the year. Okay, that doesn't mean that it's not tradable. It just means that you may want to reduce risk settings. All right, that's it. That's a quick skinny on the Brexit situation. It's now time for questions, and you can email webinars@hotforex.com for further queries. Okay, I see a question from Magnus Persson. Can you take a short time and talk about the NFP that is tomorrow? That would be great. Yeah, Magnus. So I think I briefly alluded to it during the webinar. Tomorrow's NFP is as important as any other NFP that we're going to be waiting for during the course of this year, mainly because it so much will dictate what the Federal Reserve is going to do at the next interest rate meeting, because the market is expecting quarter point rate rises throughout this year so that the US normalizes its interest rate levels over the next 1 or 2 years to around 3.5, 4%. And we're far off from that, as you know. So the NFP, the number needs to be a beat, a considerable beat, to actually put confidence or allow investors to remain confident that the US can continue to raise rates. Good. Okay, I see a good question from TradeMix, if I understood it correctly, or Trade IMX. Which currency is the US dollar against when USD is risk on? So the pure play, when there is good news, let's say, and investors are buying the US dollar, the greenback, and they're selling gold, right? That's a classic kind of cross-commodity Forex inverse correlation that you see following good news. US dollar is a risk-on asset, and its counterpart, which is a risk-off haven asset, would be the Swiss franc. Okay, so US dollar Swiss franc is a good one to trade when there is a risk-on news, or the US dollar Japanese yen, right? So the US dollar Japanese yen and the US dollar Swiss franc are assets that tend to, or pairs that tend to experience sharp rises because people sell safety and they buy risk. See a question from Amir Fakhreddin. What about current situation on Euro USD after Yellen USD plummeted? Yeah, so the USD obviously had a bit of a drop as it was a more dovish outlook. Look, the Federal Reserve has been cornered into raising rates at the pace that the market wants them to, right? Because they've been promising rate rises for years. And although Yellen has, to some degree, she did a great job in the second half of last year to kind of recalibrate market expectations, because US data simply can't keep up. The US economy simply can't decouple as people want it to or think it can from the rest of the weakness in the world. So the US dollar has fallen after Yellen's speech the other day, a few days ago. And so therefore, tomorrow, it's that much more important that the non-farm payroll number beats. Just meeting expectations probably won't work to get some of strength back in the greenback. See a question from Ghazi Sultan. I read on the internet that all British pound pairs may go down until 23rd of June. So the fact of the matter is the British pound has already weakened a lot against a basket of currencies, right? You can see that against the dollar and all that. So a lot of this is priced in. But yes, if you think about it from your own perspective, if you had to buy the British pound, would you really buy it now? No, right? You'd either sit on the fences, or if you had to, you may consider selling. It's up to you. But to really be bullish on the British pound right now, you have to have a real deep insight, and it has to be a no-brainer decision that you believe the UK will definitely find a way to renegotiate better terms and remain in the EU. So net, I think it probably makes sense. You could get weakness, structural weakness, in the pound, certainly against the cable, as we go into it. But in terms of, is that a trade itself? Would you kind of sell that or sell into it or short into it? That I don't know. Magnus, can you rephrase your question regarding Cameron, please? It's a question from Lao D. What are your thoughts on the British pound, Japanese yen? If UK out, massive move is reality. Yeah, Lao, I think just based on theory, theory dictates that one is a haven asset and one is kind of a risk-on asset along with an oil play, British pound, as you know. So the news would be terrible at first for the British pound. And then, of course, there will be the risk off play as well, which would result in people buying the Japanese yen. So if you have people buying the Japanese yen and people selling the British pound, you get both forces in the right direction to cause a big drop in the British pound, Japanese yen. A question from Mohammed Shazia. Which pair do you suggest to trade during non-farm payrolls? US dollar Swiss franc is the one that I trade. I find it decent, lower spread during the times. I don't have an ECN account, so I trade a normal spread account. For me, it's a very pure play on good or bad US news, right? Because Switzerland has closed for trading. London has closed or is about to close for trading when the news is normally released. Sometimes there are a few hours remaining, but generally speaking, the Swiss currency or news out of Switzerland is never happening when non-farm payrolls is released. So you have a good read, a good control on the Swiss franc, and on the base pair, which is a US dollar, you just play the long or short position based on which direction how big the beat is or how big the miss was, right? So US dollar Swiss franc is a good pure play. You can do US dollar Japanese yen for the same reasons mentioned. The only thing about Japanese yen is it is so much larger in size and volume and liquidity, and it is traded for so many different reasons, and there's always news coming out of Asia that can impact it. So I personally prefer the US dollar Swiss franc for those plays. Yeah, it's a good point from Alexandre Lahome. Alex is saying, I can imagine that the more June approaches, the more we will have surveys on what people want, either exit or not, especially out of the UK. Can it affect the market, or can we trade safely until mid-June? I think what I would look for, Alex, is the most reputable surveys. I think in the UK, Serve Nation is one of them. And you want to see a big delta in those. You're not actually looking for surveys that repeatedly show the same number, 40%, 40%. But what you're looking for, delta. So one survey showing 40%, after 2 weeks, 45, after 2 weeks, 50%. That could, on the margin, have an impact on the British pound. Absolutely. So in answer to your second question, can we trade safely until mid-June? If you really want to be safe, you're not going to be trading pairs that are affected by this, right? And there are enough pairs that are not affected by this directly. If you're going to be trading the British pound, you definitely have to take this on board, right? There's so many news items that are going to impact the British pound because of this until June. So, yeah. Okay, good question. So, 2 points from TradeMix. If a GBP is a worry, why in daily charts GBP has been going up since Feb? For example, in GBP USD, GBPJPY. It's a very good question. So, firstly, since Feb is not a big observation period, it's literally a month and a bit, right? Or actually just a month. You need to look at what the US dollar has done since February as well. Broad-based, especially after Yellen's speech, there's been weakness. So that's causing GBP USD to go up, right? In general, the oil has actually bounced up. So the second point is on oil. Oil had fallen sharply last year, almost below 30 or even at 25 at some point. And now it's experienced what we call a dead cat bounce, or what financial theorists call a dead cat bounce, right? And it's actually bounced up. And it may head back, but the point is that oil is very correlated to the British pound, as it is to the Canadian dollar and the Australian dollar. So oil going up has with it helped UK oil producers, which comprise or which have a big weighting in the London Stock Exchange, and that with it drives the UK currency up, believe it or not. So those are effects in play, weakness in the US dollar and strength in oil, that may explain the temporary respite that we have seen in the British pound and US dollar, if that makes sense. So it's not, it's not like everyone's saying, oh my God, it's game over. British, the UK economy is dead. It's leaving Europe. Let's sell the British pound. It's just there are other things at play that are important as well. So a question from Ghazi Sultan: what is risk on, risk off? So Ghazi, it's a good question. When investors have bad news, let's say non-farm payrolls is worse than expected, they get worried and they go into risk off mode. They take risk off the table. That means they don't want to buy risky assets. They don't want to buy equities. Equities is a risky asset. They would prefer to buy fixed income, government bonds, which is a risk off asset. They would prefer to buy stable currencies like Swiss franc, which is a risk off asset. The flip side of that is when the news is good, investors go risk on. So they want to buy dollar. They want to buy equities. That's why the stock markets rise. And they want to buy anything that has yield and capital appreciation opportunity. Yeah, Magnus, it's a good point. So Cameron, obviously, it has been Cameron. Magnus is saying that Cameron has been in Brussels and got a better deal with the EU, but that was not enough. I haven't gone through the deal specifics. Maybe that's something we can have another webinar on. We read up on it this week, our team internally, and there are some specific things that he's negotiating that he's already made a bit of headroom, but it's certainly not enough to sway public sentiment. And so there are much more concessions that the UK that Cameron is going to be asking for, and it's not enough. For what it's worth, my personal opinion is I do not think the UK is going to leave the European Union, but that's just a personal opinion. I think that there will be a 11th hour solution. Trade IMX, I'm not entirely sure what is not clear. All I can suggest is you write to webinars@hotforex.com, and they will forward the query to us, and I'll be very happy to answer it via email with regards to why the British pound and USD have risen since February. Okay, I see a question from Alexandra Lahome. Gold is an asset and haven asset, right? If Brexit does occur, can gold have the same big spike up like CHF or JPY? Yeah, absolutely. 100%, Alex. It's very correlated in days of bad news, so that can happen. I see a question from Magnus Persson. What do you think the European Central Bank will do now because they don't want a stronger euro? So I think obviously the European Central Bank surprised the markets recently. I think it was just 4 weeks ago, by actually accelerating the pace of QE, which has a depressive impact on the euro, right? Because they have to print more effectively. And remember, they're spending around 60 billion a month. They've accelerated that, roughly speaking. That's euros. So what does the European Central Bank do now? Because they don't want a stronger euro. This actually plays into their favor to a certain degree. You're going to get a weaker euro as a result of all this uncertainty. Because euros is a risk-on asset, so people are not going to be buying this. If they had to buy safety, you have much better other safer assets, because the European Union will be affected by this negatively. This is a question from August Holt. Josh, surely the EU is also going to be under pressure, because if the UK leaves, the EU will be negatively influenced, so trading euro pairs will be also more risky henceforth. Yeah, 100%, August. We're on the same page there. So I guess the point was that the riskiest pair would be obviously the most directly correlated pair, which would be the British pound. But that does not mean that the EU won't be affected. The EU also has a range of other factors that are affecting its daily rise and drop. So that is slightly more manageable than trading the British pound. But I agree with you that ideally, trading something like AUD CHF for an example, which is kind of concentrating your exposure, your macroeconomic exposure to oil, Australia, and Switzerland, which is risk off. That's more easier to tame and tackle. So those are the type of pairs you may want to look at, as opposed to Euro GBP, which is, it could be a nightmare. But I agree with you. So a question from Trade IMX: Is Brexit impacted by China too? To a certain degree. I mean, I think if you look at what's happening with the news from Tata Steel, which has just very recently, today or yesterday, decided to relocate its factories from the UK to China as a measure of cost competitivity. But also now, Tata is a huge employer here, especially in the communications industry. And this is a big symbolic move by a big corporation that is actually saying, look, we don't want to be part of the new whatever it is. They actually have taken the view that, look, things could get a bit uglier before they become better. And given the obvious cost advantages of producing in China versus UK, they've taken that move. So in theory, I would say on the margin, yes, the Brexit is slightly impacted by the shift of labor towards China, or shift of production, but I don't think it's a big driver. Certainly not the weakness in the Chinese currency. I see a question from Sio Baturu Andre. Should we trade patterns for GBP and rather ignore the fundamentals, as the UK data regarding CPI and wages is mostly positive? So the UK economy, you're 100% right, is it's nowhere near in the doldrums or anything like that. And yes, if you are trading, you want to trade short-term technicals. Obviously, I personally, this is not a recommendation for you, but I personally will not be trading the week going into it and the week coming out of the announcement. There's enough weeks in the year to trade and generate profit. Why does one need to engage the market there? But you, of course, should be always focused on the technicals, and maybe now is a better time to focus on short-term trades, the scalpers, and not take on too much overnight risk, not take on too much weekend exposure and all that, because of how much microeconomic news can come out that could scupper your trade. So I agree, you should trade patterns. We teach Bollinger Theory, advanced Bollinger strategies, all of which are 90% technical, right? Apart from the Bollinger Breakout, which is used in trading news, most of our strategies are traded in mean reverting markets or semi-mean reverting markets with a bit of price action, with short expires, right? Short trade durations, maybe an hour or 2 hours, something like that. So yeah, you should be trading patterns. I wouldn't be trading the news actively now with the British pound. Question from Mohammed Shazia: Why is the Swiss franc considered stable? Good question. Main reason is this: the Swiss economy is very stable even through downturns. It has probably the most powerful financial sector, pound for pound. It has decent amount of gold reserves as a country. It is export oriented. And in general, the Swiss franc is seen as a store of value, to some degree also inflation protection, and it's seen as a haven asset, mainly because of the stability of the Swiss economy. Mind you, Switzerland, should the UK leave, is the type of type of trade model that they will follow, right? So the UK will follow the similar kind of free trade agreement and various business transaction agreements Switzerland has with the EU. Switzerland is not part of the EU, so to put it, but they are very much regionally inside it, and but they have their own currency, right? The Swiss franc. Good question. Mohammed is asking, did the Swiss franc not lose its safe haven status due to the depegging? No, actually what had happened, Mohammed, is that it was becoming too expensive. The reason the Swiss National Bank stepped in, and remember they stepped in 2011, if I'm not wrong. They once stepped in the 70s or 80s, so they have done this before, but they stepped in 2011, 2010, because everything was hitting the roof, right? I mean, everything was hitting the fan after 2009, and people wanted safety, right? So gold, if you remember, shot up to 2000 massively, right? And people were looking for anything that was safe. They didn't care about yield, they just wanted safety. And so what happened is that everyone started buying the Swiss franc, and it became so uncompetitive for the Swiss to do business because the Swiss franc was so expensive. So for Switzerland, which has a decent industrial sector, their companies were getting hurt, right? Because they were priced in Swiss francs, and people had to, had to use their dwindling currency values like euro during that time to buy very expensive Swiss francs. And the Swiss franc was purely driven up by speculative moves. So again, it was very safe haven then, and it's still safe haven now. The only difference is that Switzerland did that to protect its competitiveness from a trade angle. It has nothing to do with the fact that it's a safe haven or not. See a question from Trade IMX. Would you say the Brexit will give commodity currencies upward against British pounds afterwards? That's an amazing question. To be honest, that is something that I would need to think about before I give a proper answer, because there is a lot of I think a lot of things that can happen to commodities, to the commodity markets in such an event. But generally speaking, if you look at how much UK contributes to global oil production, and if you look at how much the other nations like Canada and Australia are impacted by energy prices, natural gas prices, oil prices, it's very difficult to actually give a kind of a coherent response in terms of what will happen. Will they rise or will they fall after that? What's happening in the oil markets right now in terms of supply and demand and speculation is very delinked from what happens with the Brexit, to be honest. That's something I can say with certainty. Okay, I see a question from Magnus Persson. So you say the EURUSD will come down from the high it is now. Magnus, so one moment, please. Again, this is a fantastic question. It's something we can probably discuss for hours. Firstly, what is considered the highs from now? If you actually pull up a annual chart, which I have in front of me since 2007, 2008, look where the euro was before 2 weeks before Lehman Brothers, right? It was extremely high, 1.4, 1.5, or something around those levels, and so it's actually at near historical lows right now, right? And it's not too far from parity. It's not too far. I mean, euro has been at 1.2, 1.3 in the last kind of 5 years on average. So where it is right now, I wouldn't say it's at a high at all. So the answer is, will there be weakness in the euro going forward? My personal opinion is yes, because the balance of risk is to the downside. If the UK leaves, the euro takes a hit economically, the European project, right, which impacts the euro. If the UK stays, it's going to only stay on renegotiated terms, which will mean less money for European coffers, right? Ultimately, it all comes down to that. So net, yeah, you may see a bit of a bounce in the euro, but the euro's underlying structural issues will remain for many years to come as a project, and that will be a drag on the European Union. As we see with the most recent moves by the European Central Bank to accelerate the pace of QE, which was unexpected, that shows that there is still a disease, right? The symptoms are being addressed, but there is still a problem. Europe is still suffering from the debacle that happened now almost a decade ago, right? It's almost been a decade, shockingly, or 8 years or so. So if you ask me, I think there will be weakness continued, but we need to put things into perspective that it has been at a much higher level before. I see a question from Alexandra Lahom. If a Brexit occurs, UK banks can be in trouble. If yes, do you think that a systemic bankruptcy can occur in other countries? This is a very interesting question, not one that I've thought about. The UK banking sector is very, very intricately linked to the US um, banking sector. That's something important to note. And it is to some degree linked to European, from the lending side, to the European banks. Um, I'm not too worried about that, to be honest. I think the financial sector will be relatively impervious, uh, save for job losses and all those things. For example, Europeans that are working in London may be asked to leave or whatever. I don't think that will happen as well. But I think in general, I think the financial sector will be relatively unperturbed owing to this. I do not think there are systemic threats to the bank balance sheets, and the main reason behind that is the bank balance sheets now are in a different league to what you had before Dodd-Frank and Basel II and Basel III, right? So the banking sector has changed. Um, the tier one capital requirements, the tier one equity ratios that you see at banks are higher after regulation. Banks are well capitalized, generally net cash rich, right? They're hoarding cash. So again, this is a blip that you in the financial sector. I think you will see it played out in the currency markets, but I don't think you're going to have a systemic impact and bank runs and all of that. Firstly, you have to understand UK is, and I'm not British, but I have to give them a lot of credit. I have been living here for 15 years. They're amongst the smartest people in the world. And I can say this because I'm not actually biased, but technology wise and everything, they have brought a lot of inventions to the world. And if you look at the economy, nothing works perfectly, of course. And to some degree, one can understand the national sentiment to be away from Europe because one views Europe as a sick project at this moment. Unfortunately, right? That's how people view Europe. But actually, Europe is a beautiful project. It's only 43 years old in its current 28 member configuration, and maybe it needs another 20, 30 years to really iron out the issues. But this is the first test that Europe had as a joint community, right, after Lehman. And it's not done too bad. It's not done greatly, but it's not done too bad considering that you don't have a common uh, fiscal policy, a common monetary policy. You just don't. You have varying national agendas, right? Um, whereas in the US, you have a economy which has a unified federal banking system, a unified monetary policy, and you have 50 states, two times the amount of states that you have in Europe. So I think it's a matter of time. But with regards to the UK, I think their financial system is very, very resilient, very, very resilient. If you just look at the currency markets, London accounts for 40% of daily traded currency volumes. They are at the pinnacle of innovation in the financial sector as well. So I'm not worried at all about systemic bankruptcies or anything like that. That stuff they will iron out before they leave. I see a question from Chiobata Andrea. Do you think the GBP will have, in case of a stay vote, the same tendency it had after the Scottish referendum? Good question. The Scottish referendum, just a while back, actually, which would have hurt the GBP. And yes, if there's a stay vote, you will probably see, and again, this is not investment advice, and don't trade this, but in my opinion, I would say you would get a sharp rise in the British pound against a basket of assets in the event that they do vote to stay inside. But here's the thing, in the next few months, you will already find out what type of progress Cameron is making with the renegotiations, right, with Europe, and that will give you a better clue on how the 23rd of June will pan out. Okay, so that itself is an early indicator. But yeah, of course, if they vote to stay inside, the British pound stands to benefit. Okay, good question from Amir Fakhreddin. What would be the situation if Brexit doesn't happen? What will be the impact on British pound and euro? Net net, British pound rises, and euro, again, euro has other issues, but net net euro will experience some uplift, but not much. Okay, Magnus, you're asking, but the central bank have said that course over 1.14 is a problem for EU. Yes, I agree, Magnus. So here's the thing. I mean, the biggest net beneficiary of a weak euro has been which country? Germany, right? Because 70% of their products are exported abroad and they're manufacturing and industrial driven, and they benefit from a weak euro because their products are priced in euros. It has been the single handedly biggest net beneficiary of a weak euro. So the biggest engine of the European economy is Germany, and they are basically saying that the European Central Bank doesn't have power over Germany. It's probably the other way around. They're basically saying that, look, tell it to the markets, tell it to everybody that we need a weak euro. So sell the euro because that will allow us to bring Europe out of, I'm not going to say bankruptcy, out of weakness, right? So the weaker the euro, the better it is for the engines, the economic engines of uh, of Germany. So I agree with you. I think we're kind of agreeing on the same thing, but maybe I missed your question if you want to rephrase it. All right. Any more questions from anybody? Last call for questions. A good question. Great question from Mohammed. Mohammed is asking, why does Germany oppose QE? The main reason, Mohammed, is they have to pay for it. It's coming out of their balance sheet as well, and they're the biggest contributor. Germany is also the biggest contributor to the Greek bailout. Alexander's asking, do you have some links so we can follow Cameron's negotiations? Unfortunately, I don't, Alex, but if you email webinars@hotforex.com, I'm sure the competent staff of Hotforex probably has some place where they can furnish you with that. Sure, Amir. Sure, Magnus. Thank you, August. Okay, I see a question from Chiobata Andre. Regarding the GBP evolution, I was referring about what will happen after the initial spike. Um, well, that's a tough one to say, Chiobata. The obvious analysis would be that after the initial spike, you would get a bit of mean reversion as people as people basically sell the news after they bought the rumor, so to put it, right? But generally speaking, if the UK public votes against leaving this June, you get that spike, right? And then obviously the eye goes on the back to the economy, right? And if the UK public has voted against, but they've said, look, we are going to change our view at the next referendum if Cameron, you can't get us some better terms, then the entire spotlight will go on Cameron and how well he's able to negotiate those key agenda points, which we haven't gone through in this webinar. Maybe I should have, but we'll hold a second webinar closer to the date. I think I'm definitely, this warrants another webinar, a week probably before the actual event happens. But it will all be about the negotiations, right? So in answer to your question, what happens after the spike? It depends on the negotiations. If they go well, then that spike turns into a structural trend, right? And there's no reason why the British pound USD can't get back to 1.5, 1.6. You remember the days when it was almost at twice, when the dollar, £1 was almost $2. I personally miss those days because I was getting paid in pounds and I had a dollar cost base. See a question from Chiyobaturu, sorry. Because after the Scottish referendum, the pound initially spiked to lose 1,000 after that. Yeah, I mean, there's a lot of speculation, right? It's the retail trade, it's the retail play, right? If there's good news, buy, and that itself creates a spike. But over time, there are other factors that brought down the British pound. Don't forget that, Chiobata, you had the Scottish referendum, but that wasn't the bigger issue. The 800-pound gorilla on the Conservative Party's roster for the next 2-3 years after the Scottish referendum is, what about the UK? That's the bigger question. Will the UK leave the EU, right? forget Scotland for a minute. The bigger problem, it's not the bigger issue is if the UK leaves Europe, not if Scotland leaves UK. Scotland leaving UK will, of course, have negative impacts. And that's why the British pound spiked up, as you had a lot of short closures, right? Short positions were closed. So that's known as a short closure. But you also had risk on, people getting excited that, okay, the problems are solved. But then people realize that, hey, actually, there's a bigger uh, behemoth here. There's a bigger issue to tackle, and that's the future of the UK in the 28 member union. So that's what brought the British pound down, right? And don't forget, also oil brought the British pound down. We can't forget oil has come from 100 to 30, roughly speaking, right? And the British pound is directly impacted by that. If you look at the composition of the London Stock Exchange, a lot of British companies are geared to oil, and their profits suffer when oil prices fall. I see a question from Catalin Florian Palsu. What could possibly be the scenario on commodities, especially gold and oil, in the case of Brexit? Gold, likely to shoot up, right? Because it's a risk-on asset. Sorry, I take that back. It's a risk-off asset. It's a haven asset, so that's what people buy when there's bad news. So gold will experience a structural rise. Oil, it's unclear because you have to see it this way. Oil ultimately, apart from the speculative effects, right, is driven by supply and demand to a certain degree. And so it'll depend on OPEC's supply-demand response, what's happening to shale and other alternative energies in the US, what's happening to the geopolitical situation in Russia and other key energy and gas producers in Central and Eastern Europe. Those are the things that will impact oil, not Britain leaving Europe, right? Because oil production is not going to change. Capacities are not going to come on stream suddenly because UK feels more free, so they want to invest in the North Sea or in the Gulf of Mexico, right? It has very little to do with oil. That's my assessment. I could be wrong, but I don't see there's going to be a big impact on oil specifically. Hi, Catalin. I see you've just asked the same question again, so I'm assuming that my answer was requisite. Yeah, interesting one. Catalin is asking, what does that mean for interest rates of the of euro? So, as you saw in the last interest rate announcement, they're actually now zero, right? They've actually dropped them. They were slightly, strangely enough, for some reason, at a quarter point or 0.15%. Now they're near zero or zero. They won't go negative. That's probably not going to happen. And so a Brexit net is negative for Europe at first. So it just pushes more or puts more pressure on the European Central Bank to maybe increase QE further, right, to make up for the lost business as a result of the UK leaving. In terms of interest rates, I don't see them going any lower, to be honest. Certainly not higher in the event of an exit. I don't see that happening. But I think since they're already so low, I don't see it going any lower. Any questions? Any other questions from anyone? The same to you, Magnus. Sure, Catalin. See a question from Alex. People of other Euro countries may have asked to have a referendum too, but it's not for this webinar. Yeah, I think that's a very, very good point. If you remember 2 years ago when Greece was having its referendum, 2 or 3 years ago, was a big, big event. And at that point, people were asking, is this the beginning of the disintegration of Europe, right? Once it was called a Grexit, if you recall, and then people were already talking about the Brexit at that point. Will UK follow? Will Portugal follow? Will Italy follow? Um, will Spain follow? None of that really happened, and that's good to see. It's also good to see that Greece hasn't left, although much to the economic detriment of many neighboring countries, including Greece. But I think generally speaking, that question has always been on people's minds in terms of if one leaves, does it set a precedent for others? Last call for questions. Sure, Alex. Magnus is asking me what did I have for dinner. No, Magnus, that that wasn't a burp. It wasn't. It was may have sounded like one, but it wasn't. Yeah. Okay. Thank you all for attending. I'm glad it added some value. It's obviously a bit of a complicated topic, but as you know, we always hold these topical webinars like um, the U.S. and Chinese currency wars. We held one on the Scottish referendum, if I recall, as well, and Europe, what lies ahead for Europe. And we're always going to be holding these topical webinars as well. You can always write to webinars@hotforex.com if you want us to cover a specific topic. Then we always get our research crew on it, right? We have a small team of analysts that do the work. Um, and we can do that for you, but you need to write to webinars@hotforex.com and ask them what exactly you'd like to see from us. And yes, Kathleen has recommended we can repeat this topic as we're closer to June. Absolutely. We'll bring this up possibly in the week before the public referendum, just to, kind of remind everybody that, hey, this is happening very soon, so that they can calibrate their risk or what have you. Okay, so at this point, I'm going to wish you all a good day and probably a good weekend, and I'll see you all next week. And we will continue with our technical series of webinars. I think we're going over an interesting indicator next week. So have a good one.